Today is Thursday, March 18th, 2021. The Senate Tax Committee is in order.
We have a quorum.
And we have a quorum. We have several bills up today. You will find that they all have a common theme, which has to do with taxation on Social Security, showing certainly that this is an item that is important to many Minnesotans and many here in the Senate. And we have several bills. We will be looking at, each author will be presenting their bills. We'll ask council to describe those bills as needed. And since there will be many similarities in the bills, but also differences, then we will ask council to explain the difference between perhaps the Rude first bill and the Goggins second bill. So we'll try and make sure that the public and members have a full understanding of the broad spectrum of ways that are bills, options to better treat Social Security benefits. At the end of each of the bills, we will have testifiers. It's important that we make sure that the public has the ability to testify and also that members will be able to ask questions as well. And just to note for your thinking, each of these bills will be laid over for possible inclusion in a broader bill at the end of in a few weeks. So with that, Senator Rude, welcome to the Tax Committee, and tell us about your bill. And if I could have Vice Chair Miller move Senate File 2019.
So moved.
Thank you, Senator Miller. Senator Rude, to your bill.
Thank you, Madam Chair and Committee. Senate File 2019 is a phased-in subtraction of taxable security benefits. I've carried this bill in some form or another since 2013, and we did make some progress in 2017. But I get my first Social Security check on Monday, so I almost feel like I have to recuse myself from this topic. So, members in my district, I have Aiken County as the highest median age. So a great number of my constituents are senior citizens, and many of my constituents are now homesteading down in Florida and Arizona and Texas for 6 months and 1 day because we tax their Social Security, and so their retirement is very important to them. And so this bill attempts to, I know that not taxing Social Security ends up with a big fiscal note. So what we're trying to do here is phase it in over a period of time, taking 25% every year, phasing out 25% every year until we're done taxing people's Social Security. So it's really a simple approach.
Thank you, Senator Rude. Any further comments? Senator Rude, do you have any further comments?
No, I would just appreciate your support. And I know it does have a big fiscal note, but we have to look at priorities now and what we're going to do during this budget cycle. And I think it's time that we prioritize our seniors, especially during the pandemic. A lot of them have lost a lot during the pandemic, and giving them this little bit of income would, I think, help them a lot. So thank you, Madam.
Thank you, Senator Rude. And to that fiscal note, Mr. Wilms, can you walk through that quickly for us, please?
Yes, thank you, Madam Chair and committee members. The fiscal note for Senate File 2019 dated March 17th indicates a sort of phased-in approach of what would be the total increment remaining to a full subtraction or full removal of the taxation of these Social Security benefits to the extent that they're included as Minnesota taxable income. For comparison purposes, you can reference 2091 or a similar bill that allows the full subtraction, and then this revenue estimate is just a phased percentage of that. So in the first fiscal year, it represents 25% of the full increment. The second fiscal year, fiscal year 2023, is 50%, so on and so forth, all the way up to the full realized subtraction in fiscal year 25 within the budget window.
Thank you. And then Ms. Pollock, did you have anything else to add to this particular bill presentation or bill council?
Madam Chair, no, nothing more.
Thank you. Thank you. And then members, I do see a few questions. Well, perhaps not. I thought I saw a question there. All right. With that, we will, Senator Miller renews his motion that Senate File 219 be laid over for possible inclusion. And note, I would like to encourage all the testifiers at the end of these bill presentations. So you have not been forgotten. Some would say we're saving the best to last. No, just kidding. All right. So next, members, so Senator Miller renews his motion that Senate File 2019 will be laid over for possible inclusion. Next on our agenda, members, thank you,
Madam
Senator
Chair.
Root. Next on our agenda is Senate File 273, Senator Goggin. And Senator Weber moves that Senate File 273 be laid over for possible inclusion. Senator Goggin, to your bill.
Thank you, Madam Chair. Thank you, members. I really appreciate this opportunity to present Senate File 273 to you. Last time I presented my Social Security income tax repeal bill, it was one of the questions asked it from a committee member was, what about pensions? What about other retirement accounts? And back in January, I received an email on January 13th from a coworker of mine who was retiring on the 15th of January. And he said, I just wanted to say thanks for your help over all these years, and it was a pleasure to have known you. I'm headed out of state after 33 plus years in Minnesota, as I need to get out of these taxes. Good luck in your efforts, Mike. He moved to a no state income tax state. And so pretty much I'm going to echo what Senator Root said. I have received so many emails from people over the years and stopped in the stores and said, what are you going to do about Social Security income tax? Why are we getting taxed so on this? We're one of 13 states that still taxes some or all of Social Security income. So getting back to the bill, my bill goes a step further than Senator Root's. It removes the Social Security income tax altogether, but it also includes pensions and other government approved retirement accounts such as 401ks, 401as, and other retirement income. So folks have worked their entire lifetime. They've saved the money in their retirement income accounts. Let's let them reap the benefits of their hard work over their lifetime. So with that, I'll end my testimony and stay on the line for any questions.
Thank you, Senator Goggin. Ms. Pollock, could you briefly describe a little bit we understand the difference between the two bills that we just heard, 2019 and 273, but could you delve into a little bit about the new additions in Senator Goggin's bill that are also excluded? And then following that, I'll ask Mr. Wilms to speak a little bit to the fiscal implications of that provision of Senator Goggin's bill. Ms. Pollock.
Madam Chair and members, yes, as Senator Goggin mentioned, this bill would provide a full immediate subtraction of taxable Social Security benefits, in addition to a subtraction of the taxable portion of essentially the list is intended to be fully inclusive of any other retirement plan. So that the plans listed are included but not limited to these plans. So a Section 401A plan, these are generally for employees of governmental units or agencies. Then the traditional, more widely well known as 401k plans, 457B deferred comp plans, SEP plans, which are generally used for self-employed businesses or smaller businesses with few employees. Simple plans, also used by smaller employers. And then the Section 408 plans are essentially the same as the SEP plans. And then finally, the Section 414 multi-employer plans. And these are plans usually a group of employers within the same industry would come together and with a plan and offer that for their employees and allow the employees to move within different employers who participate in that plan and not lose the benefits that they've accrued in the plan. And again, so the subtraction for the additional retirement plans would be, of course, any taxable portion. So if contributions were made after tax, the distributions were not subject to tax, that type of plan would not be included in this group here.
Well, thank you, Ms. Pollock. Do we know that's pretty broad and certainly understandable. We know that capital is mobile. We know capital moves, and especially in times this generation, quite frankly, looking at taking that first security check or first Social Security check in their latter years and preparing for retirement, they have weathered the 2008, 2009, the Great Recession, and may not have fully recovered from that. And then, of course, the pandemic of this pandemic and of the previous year. So certainly understanding how those have been hard hit on retirements and have not had the time to recover from those. But what, Mr. Wilms, what is first, Ms. Pollock, do we know if any other states have, we know most states do not tax those Social Security benefits that Minnesotans, for example, already purchased through the taxation on their paychecks. But are there any other states, or how many, that have this broader version that also exempts retirement income from taxation? Oh, I think you need to unmute Ms. Pollock.
Sorry. Madam Chair, I am right. States tax Social Security income and other pension income in different ways. And generally, where the states that do exclude some pension income, they exempt it to a certain level, not entirely. I can certainly get the committee a comprehensive list of how states or perhaps neighboring states tax both of these types of income, Social Security and then other types of retirement income.
Thank you, Ms. Pollock. I think that will be very helpful as we move forward with our deliberations. I know that all of us are well aware of constituents who have moved to those warmer climates for 6 months and 1 day because of the fact that their income is treated so much more favorably without the Minnesota taxation. So I think it's important that we have a general feel how Minnesota compares. What's the competition out there for keeping these retirees in our state? I think that would be helpful, Ms. Pollock. And then to Mr. Wilms, so the cost of the full subtraction, if you could give us that number, and then the number of Senator Goggins' bill, which would be the full subtraction of the Social Security benefit taxation, and also then the cost of the subtraction from taxation on those pensions and retirement plans. Can you give us those high-level numbers, please?
Yeah, absolutely, Madam Chair and committee members. So for the full, to take it all the way to the full subtraction for the Social Security benefits, for the first biennium FY 22-23, it's about $975 million in additional tax expenditure. For Senator Goggins' bill for FY 22-23, the amount is approximately $3 billion. So about 1/3 of the cost is related to the Social Security subtraction, full subtraction, and then 2/3 of it is related to providing a full subtraction then for retirement benefits. One thing I would note, as spelled out in the fiscal note, is that the number of returns for Social Security income from tax year 2018 totaled 452,000. In this case, the taxable retirement income would found on returns was 697,000 returns. So it's only about an increase in 244,000 returns that are affected by this provision. But in some cases, this income is much more sizable than Social Security income.
Thank you, Mr. Wilms. Very helpful information. I do see some questions. Senator Weber.
Thank you, Madam Chair. I just wanted to comment. I think we always look at the revenue notes on these type of things and what it costs the state of Minnesota. But I think we also need to remember what it costs our communities when we see these retired people relocating into other states. Those individuals that have had successful careers or businesses and have managed to accumulate a modest amount of wealth, when our charitable organizations, whether it's a church, a school, or any other group in our communities has a fundraiser, who's the first group of people they go to? When we have a need for volunteers, who's the first group of people we go to? Many times it's those retirees who have had a successful business career in our communities. So when we chase them out of the state, we really change the fabric of our communities. And I think that's an unrecognized cost to our state that many times we don't take into consideration.
Thank you, Senator Weber. Any further comments? I am not seeing any on my screen here. So with that, Senator Weber, would you like to renew your motion regarding Senate File 273?
So moved.
Thank you. I'll just be laid over. Next, members, is Senator Eichhorn's bill. And Senator Rest, would you like to move Senate File 441? Be laid over.
Madam Chair, I move that Senate File 441 be laid over for possible inclusion.
Thank you. And Senator Eichhorn, to your bill.
Thank you, Madam Chair, and thanks for the opportunity to present Senate File 441. And I'd like to thank the co-sponsors, Senator Goggin, Draheim, Lang, and Kiffmeyer. My bill is very similar to the Goggin bill you just heard. It provides the full deduction of the entire amount of taxable Social Security benefits received by a taxpayer during the tax year. It provides the full subtraction of income received from other retirement plans like the Goggin bill. It would be effective year 2021 tax filing year. Minnesota, as we've already learned, is one of only 13 states that still taxes Social Security income to some level. Our neighbors, Iowa, Wisconsin, South Dakota, do not tax Social Security benefits. Under current law, 85% of Social Security benefits are subject to some type of income tax. In 2017 and 2019, the Minnesota legislature did take some steps to lower that a little bit, but obviously there's still more work to do, as we can see here today. And we really appreciate the comprehensive discussion, Madam Chair, on Social Security taxes in general. We have seen several reports that have come out from different financial type magazines ranking Minnesota as at least in the worst top 10 of tax states for retirees. In 2016, Financial World ranked Minnesota number 8, and in 2019, Kiplinger ranked Minnesota the 5th worst state to retire in because of the Social Security taxes and the other taxes we have. Like Senator Ruud and Senator Goggin, I've heard from dozens, if not hundreds, of constituents that they leave the state for most of the year. They stay here for 6 months and 1 day. I've got 2 neighbors in my neighborhood that do exactly that. And the most common thread I hear is, if we battle the weather, if we have to battle the weather, why should we have to battle the taxes too? And so they end up in those other places. And Senator Weber made a great point. We don't see the financial aspect to the state on the other side of it by not having those people in our communities and their great contributions to our communities. So I think our seniors, like everyone else, have been hit hard during COVID. And I realize it's going to be a tough battle to get the entire amount deducted, but I appreciate that you're hearing bills that even take additional incremental steps, because we do need to do something for our seniors. So I appreciate the discussion, Madam Chair, and I'll stick around for questions as well.
Thank you, Senator Eichhorn. Ms. Pollack, are there any differences between the 2 bills that we just heard?
Madam Chair, no, the Eichhorn and the Goggin bill are identical.
Okay, great. Thank you so much. Members, any comments or questions on the Senator Goggin's bill or Senator Eichhorn's bill? And I look forward to hearing from our testifiers as well. So, and we'll be getting to those momentarily. All right. Senate File 441 will be laid over. The next Social Security bill on our agenda is Senator Dornick's bill. That is Senate File 2591. Senator Weber, would you move that, please?
So moved.
Thank you, Senator Weber. Senator Dornick, welcome to the Tax Committee. I think it's your first time in front of the Tax Committee. Very good to see you. Could you please introduce your bill for us?
Thank you, Madam Chair and members. Yeah, Senate File 2091 is, again, full subtraction of taxable Social Security benefits. So we definitely have a common theme here. We do need relief for the seniors. This bill provides a subtraction of taxable Social Security benefits for the purpose of calculating Minnesota taxable income effective in the year 2021. In my district, there's over 20,000 people over age of 60. This is 1/3 of District 27. Of all these people have been paying in Social Security tax for decades. So this bill allows these seniors, as they're going to receive those benefits, to get that tax benefit, and that's been a common theme. It's something that definitely we need to address. Again, I liked the comments with Senator Weber too, with many are really relocating to the states, and it's a common theme that I've heard throughout the district, that this is a need for our seniors. So seniors on fixed incomes need relief. We have some surplus. Let's help our seniors out, and I hope I can have your support for Senate File 2091. Thank you, Madam Chair and members.
You're muted.
You're muted.
It happens, doesn't it? All right, Senator Bach.
Well, Madam Chair, it might be helpful if Mr. Wilms could remind us how much Social Security is exempted from taxes now under current law, and kind of what percentage of Social Security filers pay no taxes on their Social Security now. Because I do think most people think they pay taxes on their Social Security. I'm just not sure that that's true. So kind of to Senator Dornick's point, you can't use the number of seniors you have in your district as the number that pay taxes on Social Security, because it's not the same thing. So maybe Mr. Wilms could help the committee with that.
Yes, thank you, Senator Bach. I think that's a good lesson for us to hear, to remember. So, Mr. Wilms, if you could talk about who's paying and how much, what those rates are on the Social Security taxation now, and also if you could give us just a little bit of that history lesson, because we have taken some steps as our budget has allowed to reduce that taxation. So you could kind of give us a snapshot of the current taxation on Social Security benefits, as well as referring to the changes that have been made in the last few years. Mr. Wilms.
Madam Chair and Senator Bach and committee members, there's approximately 2.7 million resident returns in the state for the individual income tax, and about 565,000 of those returns in a recent tax year had Social Security income, and that's not necessarily the portion that's taxable. That amount is 352,000. So there's 352,000 returns that paid some state tax on Social Security income. And as the committee members are familiar, Minnesota starts with the federal treatment of Social Security taxation. So taxable Social Security income takes that, imports it into the state code, and then provides an additional subtraction on top of the federal exclusion that exists. And so that subtraction was first established in 2017 and then was expanded again in 2019. The current amount of the subtraction is approximately 80 million per year. So compared to, for instance, what it would take to get the increment is another 470 million. So currently under current law, 80 million is the tax expenditure amount. If you were to go the full, subtraction, the total tax expenditure would be 550 million. And kind of to Senator Bach's other question, I would say a good chunk of the tax is already excluded, both with the federal treatment and the Minnesota treatment. But basically, it kind of breaks down. It's hard to put a precise income amount on it, but if a filer, for instance, has adjusted gross income, below 50,000, it's likely that they're not paying any tax on Social Security. I'll follow up to the committee with some statistics about that as well.
Thank you, Mr. Wilms, and Senator Bach for the good question. I think that will be helpful information as well as we look at weighing. I'm sure we all would like to totally eliminate that taxation on those benefits, but it does have a cost, and we do need to get the most relevant information in how much is being paid, who's paying it, at what income levels, and that type of thing. So that will be incredibly helpful. Thank you, Mr. Wilms. Senator Dietz.
Thank you, Madam Chair. And if Mr. Wilms could also include in that how much these bills, so you have the group of people that are already not taxed by Social Security, and then you have these bills, at least some of them I believe will help higher income people. And so if Mr. Wilms in his research could break out how many people making over 100,000, how many people making over 200,000, what is their relief in these bills versus somebody making, $45,000, $50,000. Senator Ruud mentioned that she probably has the oldest age district, and I'll just point out for comparison, I believe with having 3 college students in my district, I might have the youngest age. And I know, we talked about when these people move, and I would ask how many of them are actually moving due to the weather first and then taxes second, if that's just an after effect. Because I know a lot of people that move due to, when they're older due to the weather, because they are afraid to go walk around outside in the winter due to the ice. So, what is the impact of them leaving? Well, what is the impact of $3 billion in the next biennium is a lot of money. And what is the impact when we keep shifting this and shifting it, we're giving that benefit to higher taxed individuals, and then we're saddling our students on debt. We're saddling these working families with childcare costs. And so, we do need to balance all of that because we just have a lot of competing needs. So I just want to remind people we have those competing needs, and if we're giving tax relief to some, we're actually shifting that burden potentially onto others. And so kind of looking at where that is. And then I think nationally, and I'm sure Minnesota is the same, women usually, because they're in and out of the market and they get paid less, so their Social Security is less. And so is there any way to do a breakdown to see how these bills impact women versus men? Because I think, you have a lot of women that live longer. And so, do these bills actually help them, or is it actually helping a small subset of, men who have higher paid jobs? So just kind of curious on what we can break out to see who this relief is actually benefiting.
Thank you, Senator Dietz. Mr. Wilms, that's quite a list. I think these are very important pieces of information that will really help us as we look at how best to allocate state resources, which are always scarce and never meet all the needs that we think they should. And so I think these pieces of information will be very helpful, Mr. Wilms. I will say it is hard to get to motivation as to why members, why Minnesotans move to other states. I can tell you this, and we'll have this, I guess, in the discussion later, but certainly many Minnesotans don't want to leave our state. And yet the implications of retiring or dying in our state make it such that we all know Minnesotans who've had to leave because of the financial impacts. And so those are all things we're going to need to weigh. And I think, Mr. Wilms, your in-depth analysis will help provide some great insight. So thank you. Any further questions at this point, members? I'm not seeing any. And then Senator Dornick, any final comments on your bill?
Thank you. Thank you, Madam Chair. No further comments.
Thank you.
I hope you can support this Senate File 2091. Thank you.
Thank you, Senator Dornick. The bill will be laid over. The next on the agenda is Senator Eakin. Welcome to the committee, Senator Eakin. Senator Bach moves Senate File 558. Senator Eakin, to your bill.
Great. Well, thank you, Madam Chair and members. And I also have an A2 amendment. I wonder if somebody could move that so I could put the bill in the shape and form that I would like. And this is its first stop.
Thank you. Senator Bach. Our Senator Dietzig moves the A2 amendment as an author's amendment. Do you have the amendment, members? I believe it came in a little late today. We'll grant the authors, all those in favor of adopting the author's amendment, signify by saying aye.
Aye.
So Senator Eakin, the bill is in the shape you desire with that author's amendment. I do believe it's online, so be sure and pull that up to take a look at that. But Senator Eakin, to your bill as amended.
Great. Well, thank you, Madam Chair. And I agree with the previous testifiers about the need to remove the tax on Social Security benefits. And I have a bill that does remove all the tax on Social Security benefits. I think it should be a top priority. But for some reason, it seems like we can never quite get it done. And it's because of the expense that's been referred to already, about $500 million a year. So it's expensive. And the target that we have for the tax committee this year doesn't allow for enough to even come close to covering the cost of this. And so, you know, I think that it's so important that I came up with a way, I'm proposing a way to actually pay for it and make it happen. And I think that's important here. And the way I do that, the way I propose to do it is by, it's a tax neutral bill, but it would shift the tax off of Social Security benefits and pay for it with a tax on net investment income. And the reason I came up with that is because we do pay to support Social Security. We pay 6.2% on our wages and salaries up to, I believe, about $140,000 now. But on net investment income, just more passive income, this is not taxed for supporting Social Security or Social Security recipients. So I thought this is a way that they can contribute something to supporting Social Security as well. And what I propose would currently tax those incomes, and it'd be for just incomes above $250,000. Okay, passive income or net investment income above $250,000 a year would be taxed at a rate of about 2.6%, a little under 2.6%. And remember, again, that the tax on wages and salaries is 6.2%. So it's much higher rate for those, who are earning up to $140,000 in wages and salaries. So it's still much lower than what the tax is on wages and salaries. And I think, it's also important to point out that this tax rate would vary from year to year because it would be calculated on an annual basis in order to make sure we're covering the cost of the removal of taxes on the Social Security benefits. So that is what my bill does. Again, it's tax neutral. I just felt that it's time to get it done. And so I thought this was probably the fairest way to pay for it, although I'm open to other suggestions as well. But I'd like to see it finally get done this year.
Thank you, Senator Eakin. Those revenue neutral tax bills that eliminate Social Security taxation, I know are quite complex. And so I'd like to turn that over to Ms. Pollock briefly, and then Mr. Wilms to speak to those numbers. And so we have a full understanding of this. Ms. Pollock, anything to add?
Madam Chair, no, and just a couple things. I think Mr. Wilms' information will be probably more valuable than what I can give. But yes, as Senator Eakin stated, the intent of the bill is to offset the revenue reduction from the subtraction of full taxable Social Security benefits with the tax on net investment income. And it would, as Senator Eakin mentioned, the rate could fluctuate based on the the receipts of net investment income in the previous year. And so it would require the commissioner to adjust the rate, do a calculation and adjust the rate generally every year. And I have nothing more to add. I think Mr. Wilms probably can provide some more detailed information.
Thank you, Ms. Pollock. Mr. Wilms.
Madam Chair and committee members, the revenue estimate dated March 17th, which basically reflects the offset between the full Social Security subtraction beginning in fiscal year 23, so effective for tax year 22, and then a new tax on net investment income. Note that the offsetting amount under the amendment that was adopted would only be the increment remaining, so not the amount that's already existing, the already existing tax expenditure. And as Senator Eakin mentioned, this is based on the calculation of net investment income, the imposition of the new tax, and that definition was established in 2010 for the purposes of the 3.8% federal surtax to fund healthcare reform. So the income as it's defined is defined federally. And in the revenue estimate, it shows a slight net gain to the general fund of approximately $5 million per year. But some of that is a function of how many decimal points the tax is rounded to. So it could become even more revenue neutral depending on how many decimal points are added. I don't know that I have anything else to add at this point, but certainly happy to answer any questions if there might be.
Thank you, Mr. Wilms. Senator Rest.
Thank you, Madam Chair, and thank you, Senator Eakin, for being creative in the way in which you're approaching this issue. And I am glad to have you as a co-author on my bill as well. The definition of net investment income does not include, as I recall, and Mr. Wilms can correct me if I'm in error, does not include non-taxable investment income like municipal interest. There's no tax on that. Some higher income individuals don't get Social Security at all. All of their income, all of their wealth, it comes from net investment income. So those particular folks who never paid into Social Security, never gotten it, are going to be the ones burdened with those higher income individuals burdened with paying for the Social Security benefits also of higher income individuals. And I just kind of question the equity of that. And in addition, and this is an issue that Senator Dziedzic often brings up, these bills only deal with, except with the one exception, only deal with Social Security income. They don't deal with those people that their own programs don't include paying into Social Security for their pension, like firefighters and police officers, and none of these bills, including mine, address that. So I think it's great to be looking for creative solutions that are revenue neutral, but I think as we approach them, we need to be super cautious that we're not just shifting the burden that we may come to regret later on. But I really appreciate Senator Eakin's work on this.
Thank you, Senator Rest. Not seeing any further comments. Senator Eakin, I do appreciate the innovative, neutral way of better taxation, really getting better results. So thank you for looking at that. Any further comments, any closing comments, Senator Eakin?
Well, I just want to thank you, Madam Chair, and the committee for hearing the bill. I really appreciate that. And I think it's important to note that the removal of the tax from the Social Security benefits would affect about 400,000 returns, 400,000 people out there, and it would shift it onto a tax that would affect only about 35,000. So it would help a lot more people by passing this. And again, I just think that it's time. We've been talking about this for quite some time. I think it's time to stop the talking and actually get it done. So again, I appreciate it, Madam Chair and members. Thank you.
Thank you, Senator Eakin. Mr. Wilms, I think it will be important to, in your analysis of these bills, to when you hear that the current burden on 400 and some thousand people will be placed on a much smaller group of people, we know that the amounts will be significant, and I think it's important that we have some sort of a indication of what those amounts might be. And I'm not sure what the metrics would be to measure that. Could be, I'm not sure what that would be, but I think that will be an important piece of information for us to have. Mr. Wilms.
Madam Chair, the bullet points within the revenue estimate, I think, kind of hint at what you're, or kind of get at what you're asking, and it shows that, for instance, as Senator Eakin noted, about 400,000 returns would see a benefit. That benefit would be about $1,200 per return. And then for the tax increase, it's approximately 35,000 returns, and the average tax increase will be approximately 14,500. So a smaller subset, but a higher tax increase.
Thank you, Mr. Wilms. That was the exact information that I was looking for. And those type of drastic differences have implications as well. And so we'll have to weigh all of those items. Senator Eakin, thank you so much. The bill will be laid over. Senate File 558 will be laid over. Members, our final bill today is Senator Rest's bill. Senator Rest, would you like to move your bill 1361?
Thank you, Madam Chair, and I would request that Senate File 1361 be laid over for possible inclusion.
Thank you, Senator Rest. Do you have an
amendment?
amendment?
And then I have would like to move the A1 amendment.
Members, do you have the A1 amendment in front of you? Senator Rest, it's just a few lines. Would you like to orally state those for members who might not have that, or for the public?
It simply updates the amounts that should be reflected, that where the where income would be subtracted, and strikes 2019 and inserts 2021 on page 2, line 3.
Thank you, Senator Rest. That will be incorporated as an author's amendment. All in favor signify by saying aye.
Aye.
Aye. Okay. Thank you, Senator Rest. Your amendment has been adopted. Your bill is in the shape you wish. If you could explain your bill, please.
Sure. Thank you, Madam Chair and members. I'm going to go into a bit of detail, even though my bill itself is fairly straightforward. It only has one section. You will note on line 110 that the maximum subtraction is increased for married taxpayers from $5,150 to $8,000, and that the amendment is included by changing the amount on line 111 that we just adopted. For single or head of household taxpayers, now I'm looking at lines 112 to 114, the maximum subtraction would equal $6,250 as opposed to $4,020, which it is right now. And then for married filers who file separate returns, the maximum subtraction is just 1/2 each of the for married filing joint. So it's pretty straightforward, with continuing the work that was started in 2017. That was my bill. We had any number of Social Security subtraction bills up until that time. And I thought it was time to begin to recognize that that need, if you would, but that not even then, when we were having surpluses, where we wasn't responsible for the legislature to allow for all of Social Security not to be subtracted. I'll go through the bill summary and then also the revenue estimate, and then some other facts about it. But I would like to call members' attention to the letter in your packets from Senator, former Senate staff person, Keith Carlson, a retiree who has some very strong opinions about why we should not be allowing full subtraction for Social Security benefits at this time. And then also the letter from AARP, a very respected organization of senior citizens, although their definition of senior citizens starts quite young in terms of their membership. And I'm very pleased that they endorsed my bill.
Senator Russ, just a moment. I would note that those particular letters are not on the calendar, and so
they were sent out by Mr. Steinhoff yesterday, and it's part of our packets, Madam Chair.
Yes, and so for the public to see those, I'm just not sure how we'll get those letters
Mr.
out.
Steinhoff can post them.
Yes,
at any point.
I think that's important, and I think it's good that members have them for your presentation. Senator
Thank you. Thank you. So, as I indicated, what the bill does is just simply take the current subtractions and increases them modestly. You'll see that the full impact adds 40 million to the already 80 million that Mr. Wilms indicated was the current tax expenditure. And I just want to remind people that about or up to $32,000, all of that income is tax exempt from Social Security. After that, for married filing on joint, up to 44,000, 50% is, and then after that, those who receive Social Security, 15% is not taxed. The other thing I think that is often forgotten about Social Security income is that workers only pay half of it. When people talk about don't tax us twice, well, half of what was paid in on their benefit, on their behalf, was paid by their employer, at least half. Self-employed people, of course, pay both, but employees have paid only half. Employers pay the other half. And since Senator Nelson mentioned that the statements from Mr. Carlson and AARP may not be available to the public, I do want to indicate that in the third paragraph of the AARP letter, quote, AARP does support reducing the tax burden on Social Security benefits on Minnesota's middle income retirees, including Senate File 1361, that increases the subtraction to $8,000 for married couples and $6,250 for single or head of households. Having said that, however, I think it's also, and I think this is trying to respond certainly as well to Senator box questions. We need to, I think it's important as we go forward with our policy regarding Social Security income that we understand where Minnesota has come, where the federal government has come, and to use that past as a guide to the future. We have, as I mentioned, we have conformed certainly to the federal government's decision some years ago to increase the tax first to 50% and then 85% based on certain incomes, level of income, and 15% is tax exempt for every recipient. But we need to understand too that Minnesota incomes, households earning Social Security income pay no taxes at all on their benefits. They're not taxable, as I mentioned. If adjusted gross income for married joint is less than $25,000 or $25,000 for singles or $32,000 for married joint, and that up at a certain point that I've already mentioned, the taxes are applied to 85% of the Social Security income. We know that from the revenue estimates that you've been given, that fully exempting all benefits would cost nearly $1 billion per biennium. And as AARP points out in their letter, they're very cautious about putting that burden on Minnesota taxpayers in times like those that we are experiencing now. About 57% of households that receive Social Security pay no taxes. They pay no taxes. 57% pay no taxes under current law. I think it's also important to look at the distribution of those benefits. And I think you'll find that because salaries, and we know this is true in other areas as well, are higher in the metro area, cost of living, other factors. Most of this benefit, or a lot of this benefit, would come to Minnesotans in the metro area, and more than 39% of the tax reductions would be realized with incomes, with taxpayers with incomes over $100,000. And that's from, I would draw your attention to a House research document in March, even though it's a little bit outdated now, but March of 2016. So I think we need to make sure when we're moving forward here that we understand it doesn't help all retirees. It does help doing anything. It helps retirees of higher incomes. Maybe that is a reason that maybe it is taxes on their Social Security income rather than the weather or any other reason that people move out of Minnesota. I would also point out that some retirees move to Minnesota. And why do they do that? A much more important reason, and that's to be near their families. So there are any number of justifications for moves inside and outside of the state. But just to, again, a little bit more history. In 1983, President Reagan and Congress passed a bill taxing Social Security, taxing up to 1/2 of the benefits of Social Security, made them subject to the income tax. And in 1985, Minnesota conformed to that, basing it on federal AGI. As you know, we then later on in our own tax reform, we went from AGI to federal taxable income, and just now in whenever that was, 2019, 2017, we went back to following the federal government and using AGI. In 1993, Congress and President Clinton now, so these are Republican presidents and Democratic presidents, added a second tier to the Social Security taxation provision. And that's the point at which up to 85% of Social Security benefits were possibility of them being included in as taxable income. And at first, that did not include the number of beneficiaries that were subject to taxation, but it did raise that potential. In 1983, 81.8% of Social Security beneficiaries had no potential tax liability. And of those, of the 18% that were already subject to it, 10% saw their potential tax liability increase. So there has been this kind of creep upwards. In 1994, so this is now some 25 years ago, we adopted that second tier of thresholds at the federal level. And we also enacted a minimum subtraction for a decrease in taxable Social Security benefits for those years. And I can talk about some of these with a little bit more firsthand experience than some of you, because all of them, except for, all of them, starting with 1985, I was a member of the legislature that passed those changes. We know that we have a great deal of empathy. Maybe some don't have sympathy, but I think all of us have empathy for senior citizens who live on a fixed income. We know that not the increases to the Social Security benefits from year to year have been fairly minimal. And once, I believe, 3 or 4 years ago, it was zero. There was no increase. But senior citizens were indeed experiencing increases in their expenses. Their property taxes were going up, or their rent was going up, or they certainly were not living on what anybody would call easy street. And I think it's important that we continue to be very, very mindful of the impact of any of these bills on the lives of senior citizens. And we don't want anybody, whether they are senior citizens or others, leaving the state, giving their first reason as not being able to afford Minnesota's taxes. Moving to a non-income tax state, however, watch out. Those states have very high sales tax. They have very high property taxes. They have taxes in Florida on intangibles. Leave your jewels at home, because they're going to get taxed in Florida. And that's an exaggeration, obviously. But I do hope that we can continue to have a full discussion of all of the implications for every senior, to be cognizant of their situation. And there are 3 in particular that may make more of a difference in the resources that seniors have, and that is in the definition of household income that we bring to 3 credits. One may surprise you, the other 2 will not. The property tax refund.
Senator Rath?
Yes.
This is incredibly helpful. and interesting, but I do want to make sure.
I'm coming back to my revenue estimate,
I want you to
if you will.
get to that, and we need to allow our testifiers
Yes,
time.
I will do
and we
that.
need to allow
Thank you, Madam Chair.
committee members times as well. So continue on.
Yes. Household income includes all Social Security income, whether it's taxed or non-taxed. So that's very important with regard to this discussion, Madam Chair. It's also included taxable and non-taxable in the definition of household income that determines how much of a renter's credit you get. What I think might surprise people is that it also is included in the education credit. And Madam Chair, I think that's something that you might want to look at yourself.
But
Then
Senator
with regard to the
Senator Rest,
revenue estimate,
Senator Rest, excuse me.
yes,
Please, we do have to just confine to the Social Security piece, and we'll get to all these other pieces, but we must allow time for our testifiers and our members. So good information.
Okay.
Just scope it down to Social Security.
I think it's important. So with regard to the revenue estimate, and then I doubt that maybe that we could skip over calling on Mr. Wilms and Ms. Pollock. I think it's very straightforward. It explains the current law, and then it explains also that we're just raising that maximum subtraction to $8,000 for married joint filers, et cetera, and uses the house income tax simulation model to determine that. So, Madam Chair, you'll note that about 285,990 returns would be affected in tax year 2021. And the average reduction in tax would be $143. Thank you, Madam Chair and members. I do think it's important to have all of this background as we look forward to talking about the way in which we tax senior citizens in Minnesota. Thank you.
Oh, thank you, Senator Rest. That was incredibly helpful. And the full discussion has been helpful as well. And this is something we'll be grappling with as we move forward. And so I want to thank you for that excuse me. I'd like to thank you for that thorough explanation of how all these things are truly intertwined. And so with that, members, I know you have questions and comments, and we'll make sure to get to those. And Senate File 1361 will be laid over. And with that, to our testifiers, you've been very generous with your time. I thank you for allowing this full discussion of a broad ways of treating Social Security income. And our first testifier on the list, I see, I don't have that list of testifiers. I see Ms. Kadoun. Welcome to the committee.
Thank you, Madam Chair. I will just focus my comments on the new tax proposed in Senator Eakin's bill, Senate File 558. We are opposed to this new tax. I'm sorry, Beth Kadoun with the Minnesota Chamber of Commerce, if I forgot to introduce myself. We are opposed to this new tax in Senator Eakin's bill as it will undermine Minnesota's competitiveness and make Minnesota more of a tax outlier. This will undermine investment, undermine talent recruitment and retention, and create another strong financial disincentive for wealthier individuals to remain or locate in Minnesota. This tax also impacts moderate income taxpayers that sometimes just have a one-year blip in their income due to an asset sale of a long-term investment. As I mentioned, it will make Minnesota more of a tax outlier. Most states treat this income the same as ordinary income. Minnesota's top rate is already 5th highest in the nation, behind California, Hawaii, New Jersey, and Oregon. This additional 2.6% rate would be on top of our current rate. So we'd have a total tax of 12.45% just behind California. But realize California's rate starts at a much higher income level of $1 million versus this proposal of $250,000. Minnesota's high individual income tax plus her estate tax, and you've heard this in this committee before, already creates a strong financial disincentive for those in those upper income brackets to locate in Minnesota or remain in Minnesota. We've also heard from many companies regarding problems recruiting high-level talent, executive talent to Minnesota. This is even more of a concern when we have now increased telecommuting and the ability to work from any place that we've seen with this pandemic, where workers and talent do not necessarily have to reside in Minnesota. You also know Minnesota's tax revenues rely greatly on our income taxes already. And we also rely on our upper income to fund our state services. According to the Department of Revenue's tax incidence study that you just reviewed last week, 42.6% of Minnesota's state and local tax system is funded by the income tax. Of those income taxes that the state relies on so greatly, 47% of individual income taxes is paid by the top 5% of households. Those are in the incidence study with great incomes greater than $235,000. And that is greater than the proportion of their state share of income, which is at 32%. So Minnesota, as you know, already has one of the most progressive tax systems in the nation. This tax is also concerning due to its volatility and uncertainty, and that was highlighted in the revenue estimates, so that this tax will vary greatly, the rate from year to year. So it'll be really hard for taxpayers to even know what Minnesota's tax rate is. And that will make it even harder to attract investment dollars, which is a lot of the business investment that we're talking about into Minnesota. So we would urge you not to support this new tax as it moves Minnesota in the wrong direction and will ultimately hinder opportunities, investment, and growth in our state. Thank you.
Thank you, Ms. Cadoon. And I assume your comments were to Senate File 558, the Senator Eakins bill.
Exactly, yes.
Thank you, Ms. Cadoon. And then our second testifier is Dan Madden. And then members will have opportunities for questions of the testifiers and comments as well. Ms. Madden, welcome to the committee. Introduce yourself for the record, please.
Thank you, Madam Chair and members of the committee. My name is Nan Madden. I'm director of the Minnesota Budget Project. I appreciate the opportunity to testify today with some concerns about the consequences of bills you have before you to fully exempt Social Security income and other kinds of retirement income from the state's income tax without offsetting the costs. These large tax cuts would make it harder to ensure that Minnesota seniors are secure and thriving in their communities, that our kids and young people are getting off to the strongest start in life, and that families and communities are strong. As you've heard, Minnesota already takes a responsible approach to taxation of Social Security benefits, and about 2/3 of Social Security income going to Minnesota residents is already exempt. The lowest income seniors don't pay any income taxes on their Social Security income. Our concerns with these bills include their high cost, but also that the impact of the tax cuts are not well targeted. The high cost would create state budget deficits and threaten healthcare, transit, and other services that improve the quality of life for Minnesotans, including our seniors. These bills over time would reduce the resources available at the same time that the number of seniors needing services is growing, whether those be community-based services that allow seniors to stay in their homes or high-quality nursing home care. Analysis by the Institute on Taxation and Economic Policy estimates that 62% of the tax cuts from exempting all Social Security income would go to households with incomes above $126,000. So that's the top 20% of the income distribution. Some have pointed out that we need to pass these bills so that fewer Minnesota seniors will move out of state. But the research that I'm familiar with concludes that there's little evidence that tax policies, including tax preferences for seniors, are a driving factor around decisions to move, which isn't to say that it doesn't happen, but patterns of migration by seniors in the US have been fairly steady over time, even as state tax policies have changed pretty substantially. Some have also pointed out that other states don't tax this income. Those other states are facing some serious financial problems down the road that will make it more difficult to provide the tax services that seniors count on, as well as invest in their schools and communities. The cost of senior tax breaks provided by states is expected to more than double by 2030 as the number of seniors grow. You certainly have heard compelling testimony about the contributions of Minnesota seniors to our states and the struggles that some Minnesota seniors face. But rather than exempt all Social Security and retirement income for all income levels, I encourage you to instead take a more targeted approach to the needs of Minnesota seniors that also focuses on the need to sustainably fund public services that they and other Minnesotans count on. Thank you.
Thank you, Ms. Madden. And I know members, I believe, will have questions as well, but just to, I just want to thank the committee and the public and the testifiers. This is a critically important issue. And one thing that we've seen is that certainly money moves. And now we know that you don't have to be bound by where you live in where you want to work. And so we've always known that capital is mobile and moves, money walks. And now we realize that people can walk as well and still live, still work in a state, in other states, even more than they have in the past. So these are new things that we will need to consider moving forward. And the challenge is truly how to make sure that Minnesotans are in a place where they're not forced, or their CPAs tell them, you really can't afford to retire here or die here. And I think as Senator Rest was kind of giving a more broader view of how taxation in general and incomes affect Minnesotans, I think that is so true, particularly when we look at the estate tax, the Social Security tax, and all of these things. And, Minnesotans have a lot of tools at their hands to figure out what state to retire in that is going to best protect them and their estates. And so I think these are things we have to really struggle with. I think the information we'll be getting from Mr. Wilms will be incredibly helpful. I would encourage members to look at the Twin Cities Business Journal. That I believe it was a 2014 following the Dayton administration's $2 billion tax hike, and seeing how money moved out of the state following that. And it kind of got to that question about why did they move? And there were some surveys, but of course they weren't totally complete. Not everybody was willing to answer those questions, nor could they really track down all of those who moved out. But with the data available, about 75% moved because of how it impacted their incomes and their estates. So I think those are important things for us to keep in mind, because at the end of the day, we want Minnesota to be a state that is a high quality state that has good qualities of life, and we know that takes money. I'm really focused on making sure we have those economic engines to continue to produce those revenues for our state that make Minnesota a great state to live and work and retire in. So with that, members, though, I do want to hear questions from members or comments. We've had a significant hearing today. I'm not seeing any further comments from members or questions. Senator Bach.
Well, Madam Chair, as we contemplate what we can maybe potentially do on this year, let me just suggest, I think it's worth making some additional incremental progress. We're likely going to have to figure out how to pay for it in the bill. So, I mean, it could be there's some ways, maybe on the tax expenditure budget, to look for some things we could link to this. But I think there's an important conversation to be had, to Senator Weber's point about the value of having seniors with some financial means in your community. It's about more than just the charitable contributions they make. They've got time, and they serve on nonprofit boards, and what's always concerned me some is, and I've got some neighbors up on the lake that are very careful about being out of Minnesota for 6 months and 1 day for fear of the Department of Revenue coming and auditing them. Many of them have some Minnesota income, so they have a tax return. But I think we need to think about what are the other ramifications when those people with some financial means leave. And I know they're very careful with the residency issue, so they probably don't use Minnesota accountants for any of their work. They probably don't use Minnesota investment managers for any of their work. They probably don't use Minnesota insurance agents. They probably don't use Minnesota legal services. They're very careful about the number of charitable contributions they give in Minnesota for fear of looking like a resident. So I think there's a number of things that there's an important conversations to be had that really are kind of ancillary to the whole tax issue, but are real impacts in our communities. So, I mean, this would be a nice thing to do if we could figure out how to pay for it. But Madam Chair, I just would encourage you, let's kind of continue that conversation about the contribution that many of these are younger seniors that leave at a pretty early age, and they have a lot of things they could contribute to our communities. And you know, a lot of them leave because of the weather. I get that. My bones are getting creakier as I get older. I haven't drawn my first Social Security check yet, but I could. But so people have a number of reasons that they leave, and I think taxes shouldn't be at the top of the list. It might be a consideration, but we shouldn't be in a position where it's kind of the overriding decision. And I say that relative to the estate tax provisions too. I think you need to be careful that that isn't the overriding consideration. I think weather should be the number one thing, not taxes. And for some people, it might be taxes. So I think we should try and make some additional progress on this issue to the extent we can afford it.
Thank you, Senator Bach. Any further comments or questions? Or questions for testifiers? Seeing none, members, it has been a thorough discussion today. Mr. Wilms will get us some more of the information as far as tax incidents and how some of these proposals would affect different Minnesotans. It is my hope as chair that we will make some progress on relieving Minnesotans from some of the taxation on Social Security benefits. Certainly, they've already purchased those benefits with their payroll taxes or with their taxes at one point, and then to tax them again is a issue in and of itself. And we have to look at the larger issue too of encouraging more Minnesotans to stay in our state. We want to keep that wealth in our state, and we want to be able to encourage greater economic growth throughout our state. And I know these are difficult issues that we'll be struggling with as we move forward. I want to thank all of the bill authors for thoughtful presentations, different ways to look at how we can how we can really make Minnesota a more competitive state. We've talked about that for a long time when it comes to employers, and how do we retain our Minnesota employers? How do we attract new ones? And how do we encourage innovators? We've often had that discussion. And today, more than ever, we also need to have that discussion about retaining our retired Minnesotans. And how do we do so? And how do we do so in a way that does not discourage them from retiring in Minnesota? And how do we do so in a way that encourages growth in our state budget at the same time? Or in our state revenues, so that we can fund those things that require that Minnesotans expect and require. So, members, the conversations will continue. Mr. Wilms will get us more information. Our next meeting will be Tuesday, March 23rd. This meeting is adjourned. Thank you.